You're listening to the Visible Expert Podcast, where we share stories, research, and actionable insights to help B2B marketers and practitioners drive extraordinary growth in their professional lives. Thanks for tuning in to the Visible Expert Podcast. I'm John Tyerman.
And I'm Kelly Waffle.
And we are joined with our managing partner and fearless leader, Lee Fredrickson. Lee, how are you doing?
I'm doing hunky-dory. How are you?
Doing great. And we have a great interview with Chris Mercer today. And Lee, you know Chris well, and he's a friend and a compadre.
Yeah, we've been following Chris for quite a while, and he was actually in our first Visible Expert book. One of the first people we researched, and I think when you listen today, you'll find out why. He is the real deal.
He is. Yeah, and I took away a lot from our chat with Chris, and it was like I was back in finance class again. Yeah. It was great.
Will this be on the test?
Exactly. So why don't we go around the table and let's take one thing that we took away from our interview. Kelly, you want to start?
Yeah, I'll just say that you should really listen to the podcast for no other reason than to get Chris's sense of the characteristics that you should be looking at as you're trying to put a value on your organization. So a lot of positive characteristics and a couple of negative things, and I think there'll be one or two surprises in there that you may not have considered before. Lee, what did you pick up?
Well, hands down, I think it was he did a excellent job of showing the relationship between visible expertise and the value it brings to the firm. Mm-hmm. And not just value in squishy value, but value in dollars and cents. What is that firm worth? And how you balance that between an individual and your whole team. I thought that this was right on and extremely valuable. Mm-hmm. Very actionable.
I guess my takeaway was his take on the risk of building up a personal brands within an organization and how that can increase the risk of your value.
Mm-hmm. So finding the right balance.
Finding that right balance. So that was the one thing that I took away that I thought was really impactful. So any of you listening out there, I think those are some great things, and there's much, much more that Chris went into. I thought his story was great, how he started out down in Memphis, Tennessee. So that was very good. This episode is sponsored by the Hinge Research Institute. If you're involved in marketing demand or lead generation and want to use a data-driven approach to content strategy, consider using Original Research. The Hinge Research Institute offers a range of services from tiered sponsorships of original studies to custom research on specific industry challenges. And we found that high-growth professional services firms are 3 times more likely than no-growth firms to using original research in their content strategy. And, according to Forbes, companies who adopt a data-driven approach to marketing are 6 times more likely to be profitable year over year. If you're interested in learning more, email us at research@hingemarketing.com, and we'll find the right approach to using original research for you. On that note, let's dive right into our interview with Chris. Our guest today is Chris Mercer, founder and CEO of Mercer Capital, a prolific author on valuation-related topics and a frequent speaker on business valuation issues. Chris was featured in our book, The Visible Expert, so he is the real deal. Chris, how are you today?
I'm doing great. It's if I were doing any better, it would be illegal across the river in Arkansas.
Well, don't go there. Well,
no, it's a great day in Memphis.
Yeah, wonderful.
Glad to be with you guys today.
Well, Chris, you're familiar with the Visible Expert concept, where we define as people who are recognized influencers that share their expertise and experience with B2B and professional services space. And, of course, we call those the visible experts. And one of the things we like to do is share the stories of how people became visible experts. And can you tell us a little bit about your journey to becoming a visible expert?
My journey as a visible expert began based on geography. Mm-hmm. I went into business in 1982 in Memphis, Tennessee. I thought I wanted to create a business valuation firm, but basically I wanted to succeed. Mm-hmm. So I recognized fairly quickly that and I knew I wanted to build a company bigger than me. So I recognized fairly quickly, because a number of people in Memphis, where I was working at an investment banking firm before starting Mercer Capital, didn't do business with me right away because they wondered if I was looking for a job or if I was really in business. So I had to go develop business elsewhere. You think about where Memphis is located. To find maybe 7 or 8 million people, I've got to have a radius of several hundred miles. A good friend of mine started his business in Philadelphia on the East Coast, and he's got 20 million people within 2 hours. So I had to find a way to become visible. And I started out doing a newsletter here, a little newsletter here to a growing mailing list. And I began speaking. I had begun speaking while I was at Morgan Keegan, the investment banking firm. And I spoke at whatever opportunities that I could, but I did these mailing lists. So I'd been in business 5 years. We had grown to maybe half a dozen people by that time. And I did a study of everything that I had mailed out. And I had discovered that I had mailed nothing consistently to any group of people that I wanted to do business with. And that was the birth of what we called at the time Value Added, a quarterly newsletter that Mercer Capital published. It's now been supplanted by a monthly called Value Matters. But Value Added was born, and we have issued newsletters consistently since then. Now we have many newsletters, but that was the beginning of the outbound effort at Mercer Capital on a consistent basis. I was also writing. I began writing for the Business Valuation Review for the American Society of Appraisers, and that led to speaking opportunities among other appraisers. I wrote a book called Valuing Financial Institutions. My thought, and we had a niche already valuing banks because I was a bank analyst prior to forming Mercer Capital. I thought that book would put us on easy street in terms of developing bank business. What it really did, though, is it gave me national exposure as one of only 3 other authors of valuation books to the valuation community in general. And so I guess it made me a lot more visible very quickly to have one of only 4 valuation books that were out there. Now, today there are dozens and dozens and dozens, but I was at the right time at the right place. Followed that up with, I was the 80s and 90s, late 80s and early 1990s were a growth period for gift and estate tax valuation. And I became very visible talking about gift and estate tax valuation. I wrote a book called Quantifying Marketability Discounts, and the model was called the QMDM, and it's still used today by many appraisers around the country. But so I was writing, and I was speaking, and I was getting out and exposing. And during those years, the Mercer Capital brand was my brand. I recognized fairly early on that had to change if we were going to be a successful firm that had any value to it. And I began, we all along we were nurturing our younger folks. So by 2000 or so, 2001, President Bush signed the repeal of the estate tax. And in that one fell swoop, he took away half of our business. So we recognized that concentrations are not good. And our folks published a book from thought to publication in 75 days. It was called Valuation for Impairment Testing. And we were talking about how to distribute that. So I asked the question of our group, who do we want to have this book? They said, we want the CFOs of sizable companies, and we want the audit partners, and we just defined our area as the 7 or 8 states around Tennessee. I said, can we identify those people? And they said, yes. So I said, how much would it cost to put one on every desk by FedEx? Well, we put 2,500 books on 2,500 desks via FedEx, and we were in the financial reporting valuation business.
Wow.
So,
you probably put FedEx in business too.
Well, FedEx was.
They were struggling a little bit around then, weren't they?
Their struggles were a little earlier, but they were doing pretty well by then. But anyway, I began to work to consciously work to become visible, and then as we had other people who had experience and credentials, we created opportunities for them to be writing and speaking and doing those kinds of things that make them visible. And I think I'd like to think that my efforts, building the company brand, made it a little easier for them to build their own personal brands within the context of Mercer Capital. So we've been trying to do that and build not only our personal brands, but enterprise goodwill. In other words, create a company that's profitable, that is a good place to work, where people can make a career. And our retention of employees is very good. We haven't lost anyone senior in many, many years.
Wow.
So we're trying to build, just trying to build a good firm. And like I say, we just knew that we had to be visible. We made a conscious decision in the late 80s that I would be the face of the company for a period of time, and for a decade I was. And now, at this point, we've got 45 people, many of whom are nationally known themselves, and the brand Mercer Capital is, I'd like to say, I don't want to go out and compete with Mercer Capital.
Wow.
The Mercer Capital brand far exceeds my own personal brand or that of any of us here.
Wow. What a great story. What a great story.
Yeah, and it seems like you've got some very unique differentiators in there, which I think kind of propelled you along, which is a great tip for our audience. But I'd like to continue down this path here around professional services, Chris. Our research into buyers of professional services really suggests that firms are really leaving a lot of perceived value on the table by not tapping into their industry insights and expertise. In your mind, how can firms leverage their own expertise to really increase the financial value of their organization?
Kelly, that's a good question. I don't know that I have a magic answer, but our solution or our approach to this is to create niches where we can become industry experts. Many appraisal firms in the country are really generalist shops. They basically hang out a shingle like I did years ago and say, I can do anything for anybody for any price. And you want a lower price, I can give you a lower price. We call that, bottom feeding, or the race to the bottom in terms of fees. And if you're a generalist, unless you have created a very tight geographical niche, it's pretty difficult to command premium pricing. When you're well known in an industry, we are well known in the banking industry, for example. We always have been. I don't do bank valuations much anymore, but we have a group of people that do. We created a niche in the asset management space where we value RIAs, or wealth management trust companies, and other investment companies. These are financial companies that are professional services companies as well. But we've created a niche there, and our guys, Matt Crow, our president, has developed a national reputation in that industry niche. So we have an energy group down in Dallas that are focused on energy. We have people that are focused on insurance agencies and insurance companies. So what we find is that it's easier to, if you know the vocabulary, if you have some proven expertise, if you have some proven visibility, to be appreciated by clients. And one of our goals at Mercer Capital is to do business with people that we like and who appreciate us. And if the price of a plane ticket to get somewhere is the differentiator, then chances are that's not business that's going to be good for us. But niches, and then write and speak and publish in those niches and get to be well known. If Mercer Capital is a generalist firm, and I'm standing at the on the 26th floor of our building, I call it the worldwide headquarters of Mercer Capital, but
intergalactic.
I look out at the world, and it's hard to figure out where to go to develop business. But if I say, okay, I'm going to focus on hotels, then I can see several hotels and hotel companies. And for every hotel, there's a company, and I can find that company if I'm an expert in hotels. And that's just an example. But I can see lots of homes. I can see, so builders. I can see, if I focus on builders, I can find them. I can identify them. I can go to their conferences. I can do things like that. And we try to do that in the niches where we are active. And what we found is that is a more productive way of marketing. Even marketing generally, we've tried to create a niche or an umbrella in which to market to companies in general. One of our guys, Travis Harms, has recently created what he calls the Family Business Director blog, and has written a book, The 12 Questions That Keep Family Business Directors Awake at Night. What we're doing here is following up on work that I've been doing for a number of years, but basically taking corporate finance principles to closely held companies. Under that umbrella, that is the family business concept, they can find us because they recognize the concept. But if we're just trying to sell services, it's more difficult. So this is a way we've tried to enhance our effectiveness in marketing to companies in general. And then our believe me, our niche specialists are taking these same concepts into the niches, so that we can develop business. And the interesting thing about that kind of business is that people appreciate what you're doing. They appreciate your expertise. I mean, if you can help with dividend policy, if you can help solve a family problem with valuation techniques, because one member of the family wants a bigger dividend, and the other member of the family doesn't want any dividends, and if you can work out a dividend policy for them using our valuation expertise, then we become a trusted advisor, and they're going to call us the next time.
Well, that's a great illustration and example of how you really build some value there, which kind of raises another question. I've been really intrigued with the stuff you've been working with on valuing professional services firms. And, a little bit more generally, what are some of the positive characteristics that make a professional services firm valuable? And on the flip side, what are some of the negative characteristics that, you want to know about or that work against making a firm valuable?
Lee, let me answer that question indirectly first, and then I'll go direct to the question. the value of a business is the present value of all of the expected benefits from that business discounted to the present at an appropriate discount rate. Said another way, valuation value is a function of expected cash flow, the growth of those cash flows, and the risks associated with receiving those cash flows. So when you have characteristics that enhance cash flow, that's positive to value. If you enhance growth, that's positive to value. If you reduce risk, that's positive to value. So that's a little, I guess, a basic valuation lesson. But I think if you think about specialty, I call them specialty services firms. You use the term professional service businesses. We're talking about the same thing. But what I'm looking at companies that have good margins. They have good profitability. The margins for a well-run professional services firm, if it's in a good niche, would be 10 to 20%, sometimes a little bit more. And so the value of a business is the multiple on earnings times the margin. For example, if the multiple is 7 and your margin is 10%, then the value is 70% of revenue. If your margin is 20%, the margin is 1.4% of revenue, 140% of revenue. So margin is important. Professional services firms have low capital expenditure requirements and low working capital requirements, and sometimes can accelerate cash flows. Asset managers, for example, often get their fees paid in advance as opposed to in arrears, like most of the rest of the world. Professional services firms tend to have recurring business, some or a lot of it. And recurring business is good for a variety of reasons. Number one, you don't have to go find it. Number two, you don't have to replace it. So it enhances the ability to grow. Number three, it reduces marketing expenses because you have a lower threshold of new business that you have to gain every year in order to grow a given percentage. Some companies will lose 20, 30, 40% of their business every year, or 50 or 60. If you have to replace all of that, it's very difficult to grow. But if you have a core of 40 or 50 or 60% of your business that's essentially recurring, either through clients or referral sources, then you're much more stable and much less risky. So those are some of the positives. I mean, I guess brand recognition is one. Brand recognition, if you create it, creates some degree of pricing power in a competitive market. So I would say those would be a good number of the positive characteristics of professional services firms. On the negative side, one of the things that makes it possible, you create an individual brand. Mercer Capital in the 80s and 90s was very key person dependent on me. That's a valuation term, but I call it key person. It's called in books. It's called key man dependency, but it can be a key woman dependency. If the business is extremely dependent on one person for a substantial part of the revenue stream, then it's riskier than otherwise. So it's worth less. So key man risk is a potential negative issue. And then aligned with the key man risk is we all want to develop our personal brands, and that's good. But if we develop personal brands to the exclusion of developing the enterprise or the brand for the business, the umbrella under which individual professionals can develop business and create their own brands, then we haven't created value. It's that enterprise value that creates value, and it's supported by the personal goodwill, the personal brands of the individual key professionals in the business.
Great rundown, and very consistent with what we've heard and what our research shows about the thing. I once heard a person say, run if you want to build it to sell it, run it like you're not going to sell it. Build it for the long term.
Well, I've got another take on that. I wrote a booklet years ago called "Is Your Business Ready for Sale?" And one of the observations in there is that you don't know when you're going to sell your business. So it's a good idea to be ready to sell all the time. And if you run your business like it's ready to sell, one thing I can tell you, two things. Number one, it's ready to sell. And number two, it's a whole lot more fun to run one like that than it is to run one with problems.
There you go. So when you look at professional services firms and compare them to other types of business, what are some of the potential pricing differences between a professional services firm and another type of firm altogether?
When you say pricing, are you talking valuation here?
Yes.
Okay. Well, it flows from some of the things that we've already spoken about, because professional services firms tend to have higher margins. Let me drill down on that just a little bit. And they have low capital intensity. Say a manufacturing company has EBITDA of $1 million, and it has depreciation and amortization of, say, $400,000. So its EBIT is $600,000. Okay, what happens to that depreciation and amortization? For the most part, it's used to replace capital intensity, and it's not available to the shareholders for the payment of benefits to shareholders, the reduction of debt, or anything like that. A professional services firm might have $1 million of EBITDA, and it might have $50,000 of depreciation and amortization, because we don't need buildings. We don't need lots of equipment. We don't have to buy inventory. We don't have to buy all of that stuff. So I have $950,000 that's available to pay down debt, for distribution to shareholders, and so forth. So what that says is that for a given amount of EBITDA, or gross cash flow, a professional services firm would tend to have a higher multiple of EBITDA in terms of its valuation because of those characteristics. And the multiple, of course, is affected by risk, and it's affected by all of the other factors that we talked about. But other things being sort of equal, a professional services firm is going to be relatively more valuable than a comparable distribution or manufacturing firm.
I'm sure there are ears out there, people listening that just perked up and said, that sounds pretty good to me. When we talked the other day, Chris, you shared that, you've developed some kind of evolving insights into valuing professional services firms as you've kind of looked at how that's been done traditionally. And could you share a little bit about how your view has evolved over time?
Sure. We've been valuing service firms and professional service firms for more than 35 years here at Mercer Capital. And when you do something once or twice, you might not notice something, but when you've done something several hundred times or 1,000 times, you begin to notice. You pay enough attention. So as we value more, we observe professional services firms that have those kind of characteristics that we talked about a little earlier. Mm-hmm. And then as we have further niched ourselves and observed other niches out there in the world, I began to recognize that there are differences between kinds of companies. I started out a few years ago, and I couldn't explain why the EBITDA, the gross cash flow, and the EBIT multiples could be so wildly different between companies. And, it's like a blinding glimpse of the obvious when it finally came through. It's the relative capital intensity that causes that difference. And that difference diminishes the greater the capital intensity, other things being equal, the lower the EBITDA multiple. And so I began to focus on that relationship between EBITDA and EBIT. And maybe that sounds like a bunch of Greek to people, but what it really means is that these kinds of firms, for $1 of gross cash flow, can deliver more bang for the buck for the shareholders, and it's just that simple. And consequently, they get a relatively higher value, other things being equal. We've seen this with insurance agencies. We've seen this with asset managers and trust companies. And I told you we've valued banks for years and insurance companies. About half of our business is financially related service companies. So the other half is corporate America. But you see it enough, and you begin to believe it.
Absolutely, I think that's such an insightful observation.
Hey, Chris, I know that you've been at the helm of Mercer Capital for almost 40 years.
What? Come on. I was only 17 when I started.
Exactly. I didn't think you were that old. Looking back at all the wisdom that you've acquired, what would you have done differently if you were given the chance?
That's a thought-provoking question, and one thing that if I were to do it over again, we've done a number of things well and a number of things right, but one opportunity that I saw that I did not grab back in the 80s and the 90s, and I didn't grab it because we were so busy with the tax-related work, that I would have figured out a way to create an outpost in Nashville and create a niche valuing healthcare companies. That could have been. There are healthcare valuation companies that are our size, and all they do is healthcare. So that's one thing that I might do differently if I had the knowledge to go back and do that. And I guess the other is that I would have slowed down my personal efforts and pushed the efforts of others sooner than I did. We worked at it pretty hard, but knowing what I know, I would probably have accelerated that effort even more, because that's the only way that you can build, a firm with substance, is to have professionals who are well known and well recognized and who attract business within the context of the firm.
Great observations.
So, Chris, I think we've got one last question for you, and you touched on it earlier, where you contend that individual professionals tend to do better building their profile when they can benefit from that enterprise brand, but doing so may also increase the risk and reduce overall firm financial value. That being said, today buyers are more likely to trust people than they are companies, so there's got to be some sort of balance there. What advice would you give to firms who are looking to raise the visibility of their own subject matter experts?
Well, I think that I've talked about brand recognition and that sort of thing, but keep in mind that you made the point well. Most of the business that we do is relationship driven. It's relationship driven one way or another. I signed up an engagement today as a result of the fact that 2 years ago I did a substantial engagement for an attorney in Pittsburgh. His partner has a similar engagement in Chicago, and the only reason that I was found was because the partner in Pittsburgh knows me. So one of the things that individuals can do, and I have this kind of rule, I violate it all the time, but it's really a simple rule to build your own personal brand. I call it 3 contacts a day. Reach out and touch a client, a prospect, or a referral source at least 3 times a day. And that can be by phone, that can be by email, that can be sending them something. But do the math. If I make 3 contacts a day, and I do that 4 days a week, and I do that 40 weeks a year, make it 42 weeks, and I got 500 contacts. If I'm conscious about it, I'll probably get somewhere close to 500 contacts, and I will be building my brand and building business while I'm doing that. Second thing I would say is that I was aware when I went into business of what I call the consultant's dilemma. And the consultant's dilemma is this. You feel like you're working hard, and don't have time for marketing. And then the work goes away. You lose that customer, and then there's nothing in the pipeline. And then you got to market, and you never catch up. What that says to me is that professionals and professional services firms have to be marketing all the time. And it's in what we do with social media. It's in what we do with our writing. It's in what we do with our speaking. It's in what we do with our reaching out. One of the ways, the third thing that I would say in that point is that I've always had what I call fallback activities. And a fallback activity is generally speaking, a marketing-oriented activity so that when my billable time slows down or stops, I have an immediate fallback activity to finish an article or to start an article or to write the speech or to, I've written several books, so I write chapters in books and that sort of thing. People say, I don't have time to do that. Well, you don't have time not to do that. It's just sort of that simple. In most professional services firms of any size, the consultants will bill somewhere between 60 and 70% of available time. What that means is that there's somewhere between 30 and 40% of time that is left. So the question is, what are you going to do with that unbillable time? Are you going to make it productive and build your brand, or are you going to sit and have another cup of coffee?
Well said.
In my case, I'd like to build a brand and have a cup of coffee. They're not mutually exclusive.
Okay.
Have a cup of coffee while you're doing a podcast.
There you go.
Speaking of that 30 to 40% unbillable time, how's your pickleball game coming along?
My pickleball game is coming along fantastic. I'm going to play this afternoon at 4:45.
Great.
And I'm looking forward to it. Look at my LinkedIn profile.
I saw the photo. That's what reminded me. I saw it.
So that's one of the things people can do is personalize your LinkedIn profile. That's just a thought. Mm-hmm. No extra charge.
Well, have fun this afternoon with that.
Well, I will.
Well, Chris, thank you so much for being on our show. I think you gave our listeners a lot of action-packed advice here. If they want to reach out to you or if they want to find you, what's the best way for them to contact you?
Contact me at mercercapital.com or mercerc@mercercapital.com. I would say that I have a blog, chrismercer.net, and I would encourage anyone who's interested. I write about some of these things that we're talking about on the blog, and that's another way to reach to me. But phone numbers are all available these days, so I won't mention a phone number, but mercercapital.com.
Thank you so much. It's been a pleasure chatting with you today.
Well, thank you. It's been a pleasure talking with you guys. It's a lot of fun to talk about this. I gave a speech with a friend of mine at the American Society of Appraisers annual BV conference in New York last week, and I talked about some of those things that we talked about right there at the end, because it is a universal issue about how to develop your personal brand.
Amen.
So if you found this podcast helpful, please rate, review, and subscribe to the show. If you are listening on Apple Podcasts, go to your podcast app, up to the top, type in the search bar, The Visible Expert, and scroll on down to the very bottom. Leave us a rating and a review. It really helps. All right, so for our listeners out there, have a great week, and we'll see you next time on the Visible Expert Podcast.